I decided to do this update to explain to you what I'm doing right now in the stock market. As you have a lot of the big seven stocks, Amazon, Microsoft, Google, Nvidia, a lot of them are crashing. And I did make a video not long ago, and I said that I was pretty much bullish on the big seven. And a lot of you were extremely confused. You're like, what do you mean you're bullish on the big seven? You've been bearish on them over the last year. How come are you bullish right now? 3 weeks ago, you made a video saying you're all in outside the big tech. And this video was based on my thesis of why the big tech stocks actually outperformed. And the rhetoric was that they were outperforming because they're amazing companies. And this is somewhat true. But this is what I highlighted in my video, which was that over 77% of the S&P 500 gains were due to the 10 largest stocks in the first half. This was as of July 2nd, and I posted it in my video. That was the second highest level in history. The highest level in history was 2007. And what did we have in 2007? We had a peak in interest rates, and we had a lot of the big stocks. The big stocks like the Big Seven and others, even in 2007, a lot of them have very good balance sheets, so they are better off with higher interest rates than the small caps that have a lot of debt that need refinancing. They're better off than the Dow stocks like McDonald's and other kind of stocks in the Dow and Dow Inc. and all of the stocks that have a lot of debt and they need refinancing, or they have dividends which are useless in a higher interest rate environment. The big tech stocks, they benefit. They collect billions and billions of dollars in interest in short-term treasuries and money market funds on the massive cash positions that they have. And they also have international revenues, which the small caps don't actually have. So the algorithm and all the hedge funds were pretty much rotating into the big tech stocks for safety, and they were dumping the Dow stocks and the small caps. And my thesis was that as this environment changed, and as we have expectation of lower interest rates, maybe through lower inflation data or something else, if we have expectation of lower interest rates, this outperformers will change. And this is why, as of 3 weeks ago, I was 95% outside the big seven stocks. I was bearish on them. I've been bearish on them for a while, I have to admit. And a lot of you believe that I just hate them, like I hate the big seven stocks, which I don't. Now I'm loving them, and I'm actually buying them, and I'm going to tell you why. That's what I do in the market. I don't try to follow narratives. I told you guys, my main goal is to make money. That's all I do. I buy things that people hate. I sell them when I love them. I combine my sentiment thesis, which I explained in this one, revealing my most profitable strategy. I combine it with fundamentals. And I had in this rotation, which I talked about in this video, I had a lot of small caps. And the small caps were doing amazingly well. But recently we had the recession fears, and the recession fears have caused them to sell off. So my small caps are going down. But I had a lot of dividend stocks and safety stocks, which I was popular amongst dividend investors, because I was saying over the last few months, this is the best time to be buying dividend stocks, and they will likely outperform as big tech starts to come down. And this is exactly what happened. And I had stocks like McDonald's, NOC, Pepsi, a lot of different REITs. We talked about Pfizer before, Bristol Myers, which is doing well, and many different stocks we had in the portfolio. And I still have some of them, but I'm going to tell you exactly what I'm doing. And for example, I had McDonald's. I was up 12.5% on McDonald's. I bought it like 3 weeks ago, and the stock has been on an insane rally. So today on Monday, I sold McDonald's, which was 7% of my portfolio, and I'm using this money to buy whatever people are hating on, which is the big seven. And the big seven are coming down a lot. And that's what I'm trying to raise cash from those positions that went up as the market was down, for me to take this money and buy whatever is going down. And you might call me a trader or whatever it is, but I don't really care. And that was my intention from the beginning. And I told you in the videos many times when McDonald's was trading lower, Pepsi and many others, I said these stocks are not only undervalued, but they will likely go up as the market's going down, which is going to provide me cash for me to be buying whatever people are hating on. And the main hate in the market is now on the big seven. You have Amazon down 19.5%, Meta down 11%, Nvidia 20%, insane. Apple, I should say Google down 16%, Microsoft, it's down 15 and a half. I didn't highlight Apple and others, but I mainly focus on those stocks because I believe they're offering the best value, especially Amazon and Meta and even Google. But Amazon and Meta are my two favorite in the market, and I really, really like those two stocks. Now, the main arguments that people will put up is if you zoom out on the chart, if you look at the year to date, these stocks are still up so much. Nvidia is still up 100%, Amazon is up 7%. That means those stocks have a long way down to go. But maybe not, because those stocks have put up most of the earnings growth for the S&P. They were doing amazingly well. Google, I believe, raised EPS like 34% this year so far. Amazon grew net income or earnings per share 100%, and free cash flow, I believe, 48 or 49%. So those companies are putting amazing numbers. And this is as a fact set in Q1. The top 5 stocks, which is Amazon, Google, Meta, Microsoft, and Nvidia, they grew EPS 64.3%. The 493 stocks, they declined 6%. So what I want you to understand is that yes, this rally in those stocks is significant. It has been magnificent. Some of it is due to the AI hype, but a lot of it is also backed by real fundamentals that are durable, and they just keep improving. So you're not only getting companies on sale with good fundamentals, but they are also better positioned or the best positioned to weather a recession if we are going to have a recession, because they have massive cash positions, amazing balance sheet that's going to allow them to buy back a lot of stock at lower prices and create a lot of value for long-term investors. Google has $100 billion in cash and short-term investments. Amazon has $89 billion, Microsoft $75 billion, Apple $61 billion, Meta $58 billion, and Nvidia as of Q1 of 2024, based on ticker.com, Nvidia has around $31.5 billion. So you're not only getting such a massive misunderstanding in the market, which is people not buying them because they're up so much, but one of the reasons why it's up so much is because the fundamentals improved so much. Like even I talked about Amazon, 100% growth in EPS and 49% growth in free cash flow. And the company is only getting started, but you're also getting them at a pretty fair multiple. And this one takes the Mega Cap 8, which is a Magnificent 7, and I believe they add Netflix on them for Yardeni research. And if you look on a historical average, and this is based off August 2nd, now we're at August 5th, so it's likely much, much lower. But even on this chart, if you look at a historical average, it's really not expensive at all, especially with the companies that are available right now, with the balance sheets that they have, with everything else, and it's likely now trading, I would say, 26, 25 times forward earnings. And even if you look at this line here on the historical average, this is not expensive at all. So those companies are not expensive at all. If you look at Google right now is trading at 19.7 times earnings. 19.7 times earnings for a company with a wide moat like Google, with an amazing balance sheet, and it's likely going to grow earnings per share 13 to 15% after 2024. You're getting a company like Amazon, 31 times free cash flow, and this is a company that's nearing an inflection point from declining in free cash flow for years and years to having stable, durable, increasing free cash flow for the next decade. And to me personally, if I look at all that stuff and I look at the values that I'm getting with the Big Seven, they make a lot of sense. And I like Amazon, I like Meta. Alphabet is not too bad, I have to admit. Apple, I don't like it very much. Nvidia, I don't understand it enough. A lot of you tell me about Nvidia, you tell me make videos on Nvidia, but I can't because I don't understand the cycle. I don't understand semiconductors. So I'm not gonna try to claim that I understand something I don't. And I really cannot predict the demand, and I cannot predict the technology and the competitive advantage. So I try to leave Nvidia alone, and I don't really understand it. So I can't say much about Nvidia. But everything else, I like them very, very much. The sentiment is bad, and some of it is warranted because they were up so much on AI. But the fundamentals are solid, and they don't lie, and they're getting better, and they weren't as bad as the market has overreacted on them. And yes, the only reason why you are not buying the Big Seven is because you believe stocks are going lower. Like, you're not going to tell me you're not buying them because they're expensive. They're not expensive. I showed you many ways of how the company is growing and the multiple is trading at. They're not expensive at all, even if you adjust for stock-based compensation. So the only reason people aren't buying them is because they believe we're going to have a massive market crash and stocks are going to go lower, which is true. But in my experience, anytime you skip an undervalued stock, just because you think it's going to go lower, you're never gonna buy the stock because you're gonna keep saying it's gonna go lower, it's gonna go lower, it's gonna go lower. When the stock market starts going up, you're gonna say it's a bear market rally. Then we go even higher, you're gonna say it's a bear market rally. You're never gonna buy in. So it just doesn't work, and it's very hard to try to time the market. So when I find an undervalued stock, I buy it, and I buy a little bit more when it goes down. I have stocks that are up. I try to trim them, sell some of them, and concentrate into my high conviction ideas. That's what I do in market pullbacks. That's what I did in 2018. That's what I did in 2020. That's what I did in 2022. And that's what I'm doing right now. And this is not a crash. This is just a correction. And I think it's likely going to end very soon. And I could be wrong, but that's what I think. And this is just my opinion on everything. I hope I was clear in explaining to you what I'm trying to do. And thank you for watching. Thank you for your support. And I'll talk to you in another video.